What happens if the AI bubble bursts? That question sounds dramatic, but it matters because the AI boom is not just a Silicon Valley story anymore. It is tied into stock markets, pension funds, data centers, energy grids, cloud companies, chip makers, and the savings of ordinary people who may not even realize they are exposed to it. According to recent estimates, a large share of Americans own stocks, either directly or through retirement accounts, pensions, index funds, or workplace savings plans. After the dot-com crash and the 2008 financial crisis, many people were told that passive investing in broad market funds was the safe long-term strategy. But today, broad market investing is not as broad as it looks. A large part of the S&P 500 is concentrated in a relatively small number of huge technology companies, and many of those companies are now deeply tied to the AI build-out. When someone contributes to a retirement fund, some of that money may end up indirectly backing Nvidia, Microsoft, Alphabet, Meta, Amazon, and the wider AI infrastructure boom. That does not mean AI is fake. It does not mean every investment is doomed. But it does mean the risk is no longer isolated to a few venture capital funds in California. If the AI trade reverses, the shock could reach teachers, nurses, warehouse workers, public employees, pension funds, and ordinary people who never chose to make a direct AI bet. That is the uncomfortable part. The gains often go to the companies and investors closest to the boom. If things go wrong, the losses can spread outward to the people least able to absorb them. So what is keeping the AI boom alive? A big part of the answer is circular funding. One company invests in another. That company uses the money to buy chips, cloud services, or infrastructure from the original investor or from a connected partner. Revenue appears, valuations rise, everyone looks stronger on paper, but sometimes the same money is moving around a closed loop rather than coming from a large base of real, profitable customers. Microsoft's investment relationship with OpenAI is one example people often point to. Some of the support came through cloud infrastructure and Azure capacity rather than simple cash in a bank account. Cloud credits can help run models, but they are not the same as money that can be used for salaries, rent, lawyers, or every other operating cost. Nvidia sits at the center of another loop. If AI companies raise money and then spend enormous amounts of it on Nvidia chips, Nvidia's revenue grows. That growth supports more AI investment. The stronger Nvidia looks, the easier it becomes for investors to believe the whole AI economy is working. But the deeper question is whether enough end customers are paying enough money to justify the total spending. This web of deals can make the system look healthier than it really is. Revenue looks impressive until everyone tries to cash out or slow spending at the same time. And the spending is enormous. Data centers, GPU power contracts, cooling systems, cloud services, memory chips, transformers, land, water, security, networking, and specialized teams all cost real money. These are not imaginary software expenses. They are physical world commitments. Some estimates suggest global spending on data centers over the next few years could reach trillions of dollars. A major share of that is expected to be financed by debt or private credit. That matters because a debt-fueled build-out can become dangerous if the expected revenue does not arrive fast enough. The basic business problem is simple. Traditional software can be extremely profitable because once the product is built, serving the next customer is relatively cheap. AI does not work like that in the same way. Every prompt, every image, every video, every long answer, every model call requires compute. Compute requires chips. Chips require electricity. Electricity requires infrastructure. The more people use the system, the more the system costs to run. That creates a strange situation. Success can make the bills larger. AI companies are betting that efficiency will improve, chip costs will fall, models will become cheaper to run, and revenue will eventually outpace the burn. That could happen in some areas, but right now, the investment is racing far ahead of proven profits. Some reports and analysts have argued that a large percentage of enterprise AI projects have produced little or no measurable return on investment so far. Many companies are experimenting, using tools occasionally, manually checking outputs, and then implementing the results by hand. AI may speed up parts of work, but a human often still has to verify, correct, and finish the job. That is not useless, but it is not the same as the fully automated productivity revolution that investors were promised. This is where the bubble argument begins. If AI infrastructure investment becomes a major driver of economic growth, but the revenue model remains uncertain, then the wider economy becomes exposed to a story that has not yet fully proved itself. If confidence breaks, it may not be a small correction. One possible scenario is an equity correction. Investors lose confidence in AI-related stocks, the biggest AI names fall, and because those companies make up such a large part of the major indexes, the broader market falls with them. Retirement accounts and pension funds would feel that quickly. A second scenario is worse. The debt side starts to crack. Unlike the dot-com era, the AI build-out is increasingly tied to enormous physical infrastructure and financing commitments. If private credit, banks, or infrastructure lenders become exposed to projects that no longer look profitable, the problem could spread beyond stock prices. The human cost is the part that often gets hidden under huge numbers. Market losses are not just numbers on a screen. They can mean delayed retirements, public pensions under pressure, reduced services, higher power prices, layoffs, and local communities carrying costs for infrastructure built around promises that did not arrive. Energy is one of the biggest limits. AI is often described as cloud software, but the cloud is not magic. It is buildings full of machines. Those machines need electricity, cooling, land, water, and grid connections. Large hyperscale data centers can consume staggering amounts of power. Some AI projects are tied to power purchase agreements, nuclear plant restarts, natural gas turbines, and huge data center campuses. These facilities can draw as much electricity as small cities. That creates trade-offs. If a region builds power infrastructure for AI and the expected AI revenue does not materialize, the contracts and grid costs do not simply vanish. The private companies may restructure or move on, but the public can be left with higher energy bills or infrastructure commitments that still need to be paid for. This is one major difference from the dot-com crash. When the internet bubble burst, it left behind fiber optic cables. Those cables were painful for investors at the time, but later companies used that cheap infrastructure to build the next generation of the web. Google, YouTube, Netflix, and many others benefited from infrastructure that overexcited dot-com companies had already laid down. AI hardware is not like fiber. GPUs and specialized AI chips can lose economic value quickly. They run hot, they wear down, and they are replaced by newer hardware within a few years. A data center full of old chips is not the same long-term gift to the future as buried fiber cable. Some buildings and power upgrades may still be useful, but the core compute hardware ages fast. So if there is a crash, the leftover value may be weaker than people expect. Another hidden cost is human labor. AI is marketed as autonomous intelligence, but many systems depend on people doing data labeling, content moderation, evaluation, testing, cleaning, and correction. This work is often outsourced to lower-income regions, where workers may be paid very little to handle disturbing, repetitive, or psychologically difficult material. That does not make the technology fake, but it does make the marketing misleading. The polished AI interface hides a messy support structure underneath: human labor, data centers, power grids, water systems, and constant maintenance. The word artificial is doing a lot of work. Then there is the security problem. A growing share of employee prompts into AI tools appears to contain sensitive information: customer data, contracts, meeting notes, source code, legal documents, medical information, and internal business plans. Many companies tell staff not to paste sensitive data into consumer tools, but then they also demand faster output and higher productivity. Employees are caught between policy and deadlines. Many choose the deadline. That creates a slow-motion data leak. Some companies have already restricted or banned public AI tools internally because staff were pasting proprietary information into them. Once sensitive information enters an AI system, especially through consumer tools or unclear settings, removing the risk is not simple. Traditional breaches are visible events. This is different. This can happen quietly, one prompt at a time. So why is the industry still pushing so hard? Because from inside the race, slowing down feels impossible. Every company is afraid of falling behind. Every CEO is being told that AI will transform the business. Every competitor is announcing AI features. Every investor wants to know the AI strategy. Not buying GPUs can look worse than overbuying them. That is how a gold rush works. Nobody wants to be the person who arrived without a shovel. Chipmakers benefit from that pressure. If companies believe there will never be enough compute, they order more chips years in advance. Demand rises, prices rise, shortages spread. Even ordinary consumers can feel it through higher prices for laptops, memory, phones, and PC parts. This is the physical side of the AI boom, not just software, but silicon, power, water, cooling, debt, and supply chains. The comparison to the dot-com era is useful, but imperfect. The internet boom was not fake. The internet really did change the world, but the timeline was wrong, valuations were absurd, and many companies collapsed before the real business models arrived. The Nasdaq lost most of its value and took years to recover. AI may follow a similar path. The technology can be real and overhyped at the same time. It can become important and still destroy a lot of money on the way there. If the AI bubble deflates, it probably will not happen in one dramatic movie-style explosion. It may happen over months or years. Investors become more skeptical. Startups fail. Funding gets tighter. Big model providers copy smaller AI apps and crush them. Companies cancel pilots that never produced returns. Expensive data center plans get delayed. Smaller players run out of money. The survivors will likely be the companies with cash, infrastructure, distribution, and fallback businesses. Microsoft, Google, Amazon, Meta, and a handful of others. Many smaller AI tools may simply be absorbed, copied, or shut down. That means AI does not disappear. It becomes more concentrated. Instead of a wild frontier of dozens of independent AI companies, the industry could collapse into a few giant platforms with enough money to survive the burn. The dream of open competition gives way to industrial consolidation. The public, meanwhile, may still be left with the costs. Higher electricity prices, strained grids, public subsidies, weaker pension returns, job disruption, and a digital world increasingly shaped by a small number of companies. That is the real question. Not whether AI survives, it probably does. Not whether some AI tools are useful, they clearly are. The question is who pays for the gap between the world that was promised and the world that actually arrives. If AI becomes practical, slower, less magical, more expensive, and more corporate than advertised, the hype will not vanish quietly. Someone will be left holding the bill. The AI bubble may not burst because the technology is useless. It may burst because the story was too big, the timeline was too short, the costs were too hidden, and the people making the promises were not the same people who would pay if those promises failed. So when someone says AI is the future, the better question is, future for who? For the companies selling chips, for the cloud providers locking in contracts, for investors trying to exit before the music stops, for workers being told to train the tools that may replace them, for communities paying more for electricity, for ordinary people whose retirement funds are tied to a market they do not control. AI may be powerful, but power is not the same thing as sustainability. And if the bubble breaks, the machines may keep running, but the bill will not be paid by the machines. It will be handed to people.